This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. I have with me this morning, once again, John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John, and welcome back.
Morning, Gord. Good to talk to you again.
Great quality here this morning on our video. I don't know, maybe it's good weather out in Idaho?
I think you're just upgrading your gear. I'm going to do that one of these days too. But in the meantime, the quality of the work that you're putting out has really gone up lately. Congratulations.
Well, maybe we're at too low a level, but anyway. Not you. I'm talking about the stuff we're putting on. John, let's just jump right in it because we always have so much to talk about, and we don't get through our list. I have up an agenda of a couple of the points, or a few of the points I'd like us to touch on. And I'd like to start right off the bat with an article that you put out here this week or last week on buybacks. It's a subject I've been talking about for a long time. And not just buybacks from what it's doing to the stock market, but buybacks what it's doing to the capitalist system. I want to share your views on that article and your views on what I just said.
Well, yeah. Basically, the governments of the world, or the central banks of the world, are buying up all the government debt that's available just about, which makes high-grade corporate debt extremely unique and valuable for money managers, because anybody who has to generate some kind of yield needs to be able to buy bonds that pay them something, and corporate debt still does. So corporations are able to borrow effectively unlimited amounts of money. But instead of taking that money and putting it into new factories and upgrading their technology and hiring more people, they're buying back their shares. And one reason that they're choosing to do this is that the global economy is kind of slowing down right now. Even after all the money that we borrowed and all the new currency we've created and all the negative interest rates we've produced out there in the world, the global economy isn't really growing. And that presents companies with a lack of attractive investment options. In other words, building a new factory in this kind of an environment, not such a great deal for a lot of companies in their estimation. So they're just buying back their stock. And in that way, masking the fact that their businesses are slowing down. Corporate sales in the U.S. have been falling for a couple of years. Corporate profits are going to be down this year. And that's usually associated with the onset of recession. But corporations so far have been able to mask that reality by buying back a lot of their stock with borrowed money. And in that way, change the denominator of the earnings per share equation to make it look like they're still making more money year after year, when in fact they're making less money year after year. So, that in one sense, it's flat out lying because they're getting away with presenting something that isn't true. And of course, why should they be any different? Because the governments of the world have been doing that for several years now, where most of the numbers that come out of the US and China and to an extent Europe are doctored in one way or another, or allowed to present conclusions that aren't really borne out by the underlying data. Companies are doing the same thing. And so, yeah, this changes the nature of capitalism in the sense that negative interest rates leveraged share buybacks by companies and lots of other accounting tricks that they've been pulling lately, change the price signaling mechanism of the marketplace, because now we don't have good information anymore. And that makes it very hard to allocate capital. In other words, when you have a market, you need well-informed participants in order to have the market operate efficiently. In other words, to allocate capital to places where it should be going. We don't have that anymore. Signaling at every level of the global economy has been distorted by governments pushing interest rates down to negative territory. And the interest rate is the price of money. And when the price of something is negative, it sends a message that that first of all we're not used to seeing, and second of all is probably a false signal. So you get misallocation of capital because people don't understand where their money should be going. And same thing with individual investors. We're looking at these companies that are reporting higher earnings per share and thinking that they're healthy and that they're growing when in fact the opposite is true. And so that makes it hard for individuals to allocate their capital. And if you don't have efficient allocation of capital, then you don't have capitalism. You don't have a system that works magic the way efficiently operating markets tend to do, where you get productivity going up year after year and products get better and cheaper. Well, that's not going to be the case going forward because we're sending money to places where it really doesn't belong. China, for instance, is a good example of that. They, coming out of the Great Recession, borrowed more money than any country has ever borrowed. And they spend it badly in a lot of cases. They've got ghost cities and these airports where nobody flies in and out, roads that are empty, and massive overcapacity in things like steel and cement. And so they're in the early stages of a credit crisis because of that, because they can't pay the bills associated with all the debt that they've taken on. Well, the rest of the world is basically headed the same way, with some differences in specifics, but great similarity in overall trend. In the U.S., we're building up really shocking levels of debt, but we're doing it to a large extent through unfunded liabilities in government pension plans. Europe, the same thing is happening, where we're not really reporting the amount of obligations that we're taking on. And so people think things are better than they really are, but the actual numbers are horrendous. So yeah, wherever you look, you see distortions in what used to be fairly efficient markets, changing the system to something that's quasi-socialism now, where the government basically just takes care of everybody via monetary policy and soon via, a new round of deficit spending, which we should talk about in a minute. And nobody has any real responsibility for their actions. So yeah, this isn't capitalism anymore.
John, you're talking about the debt, and we published the United States debt's $19 trillion. And as you said, but just a minute, we have to look at what the real debt is. And it's $84 trillion when you look at unfunded liabilities in it. 84 trillion versus 19 trillion. I've talked to Lawrence Kutlikoff here at the Boston University. He's published and presented to Congress specifically, had 15 Nobel laureates sign off on his paper that shows that the fiscal gap is 212 trillion. These are real, legitimate numbers. But the bottom line is, no matter what, even at 19 trillion, it's far more than we can possibly pay back or fund. And so we have a problem here of orders of magnitude with excess debt. But I'd like to just go back to the buybacks for just a second that's going on here. We have 1,900 S&P companies that actually paid out more money on buybacks and dividends than they made. So they're obviously borrowing that money. And now their credit ratings are in jeopardy because they have too much debt, earnings are falling, and the reason you do buybacks is because you don't think there's growth ahead. That's typically why you do it. It isn't just bonuses for the executives. The board of directors looks at it and says, do we see the natural growth? So who's buying all these bonds? Because they're still selling them, even with the risk that's in it. And can I speculate and then John ask you to comment?
Sure.
We have Apple, for example, has $200 billion in offshore money that it doesn't want to repatriate because it has to pay tax on it. IBM's the same amount. We have hundreds of billions of dollars, it's actually in trillions, of money that's been made that isn't being repatriated. Isn't that money that if you got it sitting out there that you could put it in an SPC and use it to buy back your own bonds in America as an investment? You pay a dividend on those and you don't care, but you buy back your shares, you drive up your share price even with lower earnings, and at the end of the day, you're just going to give the money back to yourself in your SPC that's offshore, and maybe you'll get a tax rebate somehow to bring it back into the country. Nobody seems to ask the question, what are they doing with all that offshore money? Is it just sitting in a bank account at negative interest rates? comments?
Well, that could well be, which would be kind of consistent with the way the rest of the world works. Is you've got governments doing the same thing, where they issue debt, and then another branch of the government, the central bank, buys that debt back with money that they created out of thin air. And that corporations are doing something similar.
Isn't that what it is? Monkey see, monkey do?
Yeah, well, I mean, it's a trick that everybody is playing on one level or another, I guess. And so it shouldn't be surprising that corporations are emulating governments in this, because governments are getting away with it. But there's a point out there where the amount of debt that corporations are taking on to buy back their stock ceases to be a positive thing from the standpoint of the share price. People are looking at companies that are getting more and more over-leveraged. And in effect, they're doing slow-motion leverage buyouts by borrowing money to buy back their shares. And there's a point at which you get punished for that instead of rewarded. And that's starting to happen. A lot of companies, like you said, there are debt downgrades happening at an accelerating rate right now. And a lot of the big share repurchasers are starting to underperform the overall market. So, let that trend continue for another year, and it won't be in the interest of these companies to keep buying back their stock with borrowed money, because it won't serve their purpose, which is to pump up the share price in the short run, which increases the year-end bonus pool for the executives doing the share repurchasing, and allow them to pull more money out of the company. Once that doesn't work anymore and the share price goes down and they get punished for it, they'll stop doing it. So I think this ends at some point. And it probably ends in late 2016, early 2017, at which point there's nobody left buying equities in the private sector. Then you've just got the central banks of the world who are buying a lot of equities. But
you just need to know, like, the biggest owner of ETFs in Japan is the Bank of Japan.
Bank of Japan.
And we got Norway, who's buying. They were originally targeted their sovereign wealth fund to own 5% of the European market. So and we could go on. And I think Denmark just announced they were buying too. But so there's no question. Hungary announced that they're going to boost their economy. They're going to now start buying the stock.
The Swiss National Bank is one of the biggest holders of Apple stock. They're speculators now.
So the government, there's no question, the governments one way or the other are getting into buying equities. They're already buying all the bonds. They're going to corporate bonds with Rahi. So there's quite a game going. I would speculate, John, and before I go back here, is that we may have a giant debt for equity swap game going on with these corporations, and that is, you drive your stock price up for all the reasons we're doing, and you have no growth. Well, the only way you can really get growth is mergers and acquisitions. So your stock price becomes currency, right? It's what you trade. You don't give them cash when you take over a company. You give them your counterfeit stocks. You just print up some more because you've elevated these prices up. Well, with a strong U.S. dollar, earnings are going to be hit. Your stocks are very, very valuable, and all these emerging markets are in deep trouble, getting hurt. There's good buys out there for M&As. And so all of a sudden, all that debt, whether you were using your cash offshore or whatever, a beautiful piece of financial engineering there, isn't there? You can't prove this, but in my gut, it tells me this is what's going on.
Yeah, well, historians will eventually prove it, when they sort all this stuff out. We'll find out that most of what we're talking about is actually true, as crazy as it sounds now when there isn't, public announcement of this stuff. But it's probably happening. And the other thing to understand about this is that corporations buying back their stock and central banks buying equities are profoundly dumb money, because they're not in there analyzing PE ratios and book values and things like that. They're across the board taking money that they've gotten more or less for free and just buying big equities out there. So it lifts all boats without any regard for the quality of each individual boat, and it distorts relative prices in the market. And people who do that, that's usually the behavior of the dumb money at the peak of a cycle, when they just get excited and start buying everything in a category, all the .coms or all the housing stocks or whatever. And everything goes up. And at some point, the decisions have become so excessive and so, horrendously wrong-headed that the market tanks in general, because everything's been pushed up to an excessive level. And then the dumb money ends up losing its shirt. And so this time around, it's going to be central banks that lose out big in the next bear market, which means taxpayers. And it's going to be major corporations, because what they've done basically is converted themselves into hedge funds, where they're using borrowed money to buy equities. And an equity bet on margin, when it goes wrong, goes horrendously wrong. So a lot of these companies are going to be sitting on treasury stock that they bought back at 50% higher prices than the prevailing price at the bottom of the next bear market. And so that's their shareholders' money that evaporates when that happens. So their enterprise value goes down dramatically, more than it just does because the business is weakening. They've also made some really horrendous financial decisions. They've got this debt that isn't going away, and the stock that they bought with it is worth half as much or less. And so the companies become much less valuable. And people will figure that out, and then their stock goes down even more. So this is the kind of thing that can really snowball once things turn down, and things will start blowing up everywhere. We'll see all these problems that were kind of papered over by zero interest rates right now start to emerge. And some of the big problems will be insolvent central banks and companies that have these horrendous hidden embedded losses that they have to report at some point, and when they come out, a lot of companies are going to look like Valeant. They're the big pharmaceutical company that just keeps reporting bad numbers and restating their old numbers, and nobody trusts them anymore, and the stock is tanking. Well, a lot of brand name companies are going to be in a similar boat pretty soon when they announce all these horrendous financial decisions that have come back to bite them.
John, we missed last month, but since then we've had Japan announce a NERP, so major set of announcements, policy announcements. Whether they follow through is a discussion. We've had 2 weeks ago Mario Draghi make some major policy announcements in the EU, the ECB, and then this week we had Janet Yellen kind of sending some interesting signals. Can you make sense out of all the three of them and what's really going on here?
Well, they're all panicking. All the powers that be in the global financial system expected something different when they ramped up their quantitative easing programs of the last few years and pushed interest rates down to zero and in a lot of cases negative. That's the kind of thing that in the Keynesian textbook says should lead to a rip-roaring boom where everybody in the world is borrowing money because money is free. And the big banks that are getting cash for their bonds when governments buy back bonds should be lending that money to everybody in sight because it's free. It's so cheap for them. If they lend it out at 2%, since their funding cost is zero, they should be doing it because it's a wise decision. Well, it's not happening. The global economy is actually slowing down and has been for the past few years. So basically, these guys got nothing in return for the tens of trillions of dollars in new debt they took on. So now they're really scared because if we have another year of slowdown, we're in global recession. And an over-indebted system can't survive a deep recession because it makes the debts that they've taken on trying to stop the recession from happening even more onerous. If your economy is slowing down and you borrowed a huge amount of money, then your debts are harder and harder to pay off. And that's the situation that the whole world finds itself in. So these guys they're going with what they know. They're ramping up their existing programs and seeing if, $10 trillion didn't work, let's try $20 trillion. If zero interest rates didn't work, let's do negative 1%. And pretty good chance that's not going to work either because if zero doesn't work, it means interest rates have stopped functioning as an informational tool for the marketplace. Nobody's paying attention anymore. And what really should be considered interesting in all of the stuff that went on in the last couple of months is that the European Central Bank ramped up its QE program. The Bank of Japan went very negative. They pushed rates down into negative territory. Those things are supposed to weaken your currency. That's a form of currency devaluation when you do that. And yet their currencies went up versus the dollar in the last few weeks, which means they got exactly the opposite of what they were hoping for. And their economies are already slowing down. Japan, generally, Abenomics is considered to be a failure because the economy is not growing. In Europe, they're actually in deflation right now. Inflation is a negative number for Europe, which is a catastrophe if you've got too much debt, because that makes your debts harder to manage. And so the fact that the dollar has gone down versus their currency, which means their currencies have gone up versus the dollar, means that they dug themselves in an even deeper hole now. They made their problems worse by ramping up their easing programs. And the question then becomes, what's left? Do you have anything left after negative interest rates strengthen your currency? That shouldn't happen. And the fact that it is happening means that your tools have stopped working. So that's the situation that the global economy finds itself in. The U.S., even though we have been, in the last Fed meeting, Janet Yellen came out and said, well, the interest rate increases will come more slowly. We're still increasing interest rates according to official policy, and the rest of the world is decreasing their interest rates, which means the dollar should still be relatively strong. And that didn't happen means that things are going to get even harder for our trading partners at a time when they can't handle any more difficulties. So expect something even bigger from them going forward. And it's not clear what it's going to be, because interest rates at negative 1% are already distorting their markets to an extent that you're seeing people react to it. In Japan, home safe sales are soaring because people are pulling their money out of banks and just storing it at home so they don't have to pay any interest to the bank. Well, once that process gets going, it's not clear where it ends, because you get people basically withdrawing from the financial economy, from the debt-based part of the economy. And that's exactly the opposite of what these guys are hoping for. They want people to be borrowing and spending, but instead their policies are leading people to hoard cash. And we've seen gold and silver go up in the last month, which is basically the same process. Gold and silver are proxies for high denomination paper cash. And so to the extent that people are buying gold and silver coins, which they are at record levels right now, that means, again, that those people are withdrawing from the debt-based economy. And so that's the early stage of the Austrian economics crack-up boom. When people just throw up their hands and say, look, I don't want to play this game anymore because it's not working for me, and I'm just going to withdraw. And then the system starts to spin out of control. So what comes next is, I think, the really interesting question. What they just did didn't work. So they've got to try something new. And what people are talking about now is ramping up deficits. People are, economists and politicians are saying, well, okay, monetary policy has basically run its course. We can't do any more with interest rates or with debt buybacks because the last batch didn't work. So what do we have left? Well, we've got deficit spending. So let's ramp up infrastructure building programs in the developed world and pay for it with borrowed money, which, a common sense response to that would be that, didn't we also just do that? We took on $57 trillion of new debt in the 5 years following the onset of the Great Recession in 2008. And we got basically nothing for it. We didn't fall into a depression, but we don't have any growth. And so all of that money was basically spent and in effect lost because we're right where we started again. We don't, in the US, have as many people working full-time jobs now as we did in 2007. So based on that very important indicator, the economy is not really any bigger than it was back then. We're not creating any more wealth. We're not making individuals any more secure or richer than we were a decade ago. And yet in the meantime, we borrowed this absolutely insane amount of money. So that probably won't work again, but it's probably what we're going to see because these guys don't have any other tools. All they've got is easy money and deficit spending. And so we should expect, after the presidential election in the U.S., there to be some kind of either an engineered crisis or an actual crisis when the economy starts to slow down, and the government respond to that with a big new program of spending somehow with borrowed money. And when the central bank is buying back the bonds that a government creates via deficit spending with newly created currency, then in effect, you're basically just directly financing the government with newly created currency. You can skip the whole bond step if you're just going to buy all the bonds back, right? And so that's kind of sort of the debt jubilee that people have been talking about for so long. If we ramp up infrastructure spending, we start building new roads and bridges and fixing the crumbling infrastructure that, in a perfect world we would be doing, and then we hire lots of people to do that work, and then we give them the money we're just creating on an electronic printing press. In effect, that's, there's a lot of steps involved there rather than just a direct transfer of money from government to individuals, but the effective result is the same thing. We're just creating lots of new currency and giving it to people. So, and presumably the people who get that money can pay off their debts, which is a debt jubilee. It's the forgiveness of debt by government fiat. And so, all these things that started out as extremely fringe, crazy sounding ideas like quantitative easing and negative interest rates and now a debt jubilee are happening. And the only logical place for this to end is with a financial crisis of just an epic scale, because there's very little likelihood that whatever we do next is going to work if the stuff we did before didn't work. You take on $57 trillion of debt and get nothing for it, then taking on $100 trillion of debt probably isn't going to do that much more good. And you push interest rates down to zero, and if that doesn't work, negative 1 or 2% probably won't work either. And yet, we have to find out. These guys, they're going to take their tools to their logical extreme because they don't have any other tools. And so right now we're in a historically very interesting time in which we're taking some ideas and we're seeing if they work on any scale. We're going to try them on a small scale, then a medium-sized scale, and then a gargantuan scale, and we'll see if they work. And so far, the indicators are that they will not work. But by God, we're going to try them. We're going to try these things, and we'll find out in late 2016 and 2017 what the result is. And I suspect the result will be pretty horrendous.
Well, Japan went to QE11, then QQE. Now they're at NERP, and their debt is beyond ever being payable. I guess we shouldn't be able to draw a conclusion here that doubling up from here is not the right strategy, but whatever. But the establishment seems to have it, and I'll use that word, in their mind that this is the only way out. And in the word of establishment, John, a last question for you. What do you think the primaries that we're seeing here in the U.S. are telling us about the social contract between the public and the government? Are we reading? Can we read anything into what we're seeing in the early stages of this presidential election?
Oh yeah, well we're seeing the same thing here as in most of the rest of the world, where parties that used to be considered of the fringe, or candidates who used to be considered way out of the mainstream, are getting a lot of votes. And the reason for that is because the mainstream isn't working anymore. The things that the major political parties have done over the past couple of decades aren't perceived to have helped regular people. They've enriched the 1%, obviously, because we've been creating lots of new currency and that money's been flowing into financial assets, which bid up the prices of stocks and bonds, which is great for rich people who own the stocks and bonds, but no new jobs are being created in the process. So people are willing to listen to alternative solutions now. And so you've got National Front, a far-right party in France, which is now the biggest single vote getter of any political party. And you've got Marine Le Pen, yeah. And she's, it's not likely that she's going to win the presidency next time around because the socialists and the conservatives will get together to keep her from taking power. But still, the fact that her party is the biggest vote getter is a really important message that's being sent. And here in the U.S., Donald Trump is basically a slap in the face of the establishment, right? By voting for Donald Trump, people are saying, look, we don't trust you guys anymore. So we're going to go with somebody new. And you know what? He's obnoxious, but he's saying a lot of the stuff that we actually think because we're really mad at you. And so Donald Trump is highly likely to be the Republican nominee this time around. Now, barring Hillary Clinton being indicted, which, it looks like about a 30% chance right now, but the 70% chance that she doesn't means she'll probably win the presidency this time around, which means we'll still be putting an established candidate in power, but the voters will have sent a message, which is that, if you keep doing the same stuff and it keeps not working, then you're out of here next time around. We will vote for anybody who's not you. And so right now we're at the one step before that point. People they're voting for fringe candidates, but in the end, they're going for the mainstream guys in most cases. The next round of elections, that won't be the case. If things don't work, if we're in recession 2 years from now, then the congressional elections in the U.S. will be just a bloodbath. And if we're in a deeper recession 4 years from now, then it's anybody's guess who ends up being president, because pretty much any fringe candidate who promises to stop the bleeding will get some traction. And
voting with their middle index finger.
Mm-hmm.
And and even in the Democratic side, with they've got their maverick there too, and Bernie Sanders. But we have Jeremy Corbyn in the UK, and we mentioned Marie Le Pen. We have Brillo in the UK, or rather in Italy. We can go around the world, and so I agree with you that the next election, if there isn't dramatic changes, they'll be voting with pitchforks and spears, because the anger that's building, and I don't think a lot of them understand what's wrong. They just know something's wrong, and they just know it's not changing, and it's more of the same. And it's pretty frightening when you just said that Hillary Clinton is the establishment candidate by default here, and if she's not indicted. So if she's not indicted, so I'm not making a political comment. I'm just trying to say there's something very seriously wrong on the political front in the system. We clearly see issues in the monetary side of it, and now the solution is fiscally just more debt. It can't end badly, or it can't end well. It will end badly. John, we have to break here. Any last comments you'd like to leave with our viewers?
No, Gord, I think we covered the waterfront here. There's a lot of interesting stuff going on, so I think next month we'll have more to talk about.
There used to be the macroeconomics was like watching paint dry. Not anymore. It's an exciting place to be. A great time for us. Talk to you next month.
Great. Look forward to it. See you, Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.